You've got the numbers coming in and going out every day. But if your chart of accounts isn't set up right, you're flying blind. Imagine trying to make sense of your financials when your transactions are lumped into vague catch-all accounts, or worse, missing entirely. And that's the real cost here: inaccurate reports, surprise tax bills, and hours wasted untangling messes that never should have happened. Today, you're going to take control by mastering your QuickBooks chart of accounts. The foundation your entire bookkeeping depends on. Why does this matter for your business right now? Because your chart of accounts isn't just a list, it's the language your financial statements speak. When you get the structure right, every dollar in your business is assigned a clear purpose. That clarity means your profit and loss statements and balance sheets reflect reality, not guesswork. Whether you're planning for growth, preparing tax returns, or convincing a lender to back your next move, clean, precise accounts give you the confidence and insight you need. And let's be real, if your chart of accounts is a mess, none of those things will be easy or accurate. So let's walk through exactly how to set it up in QuickBooks, starting with understanding the 5 core account types. You've heard this before, but it's worth drilling down: assets, liabilities, equity, income, and expenses. Think of assets as everything your business owns: cash, equipment, inventory. Liabilities are what you owe: loans, credit cards, unpaid bills. Equity is your stake in the business, like retained earnings and owner contributions. Income is all the money coming in from sales or services. Expenses are what you spend to keep the business running: rent, salaries, software subscriptions. Open QuickBooks and go to your chart of accounts list. You'll see QuickBooks sets up a default structure based on common small business needs. The first step is to review this list carefully. Delete any accounts you know you won't use. For example, if you don't have inventory, remove inventory-related accounts, and this keeps your list lean and focused. Next, add accounts specific to your industry or business model. Say you run a marketing agency. You might add client project expenses or ad spend as expense accounts. If you're a retailer, you might add cost of goods sold, apparel, or online sales revenue. Don't just settle for QuickBooks defaults. Customize so your books tell your unique story. Now, about sub-accounts, these are your secret weapon for detailed tracking without cluttering your main list. Let's say you have a main expense account called utilities. Under that, create sub accounts like electricity, internet, and water. This way, your high-level reports show total utilities, but you can drill down when you need to analyze specific costs. Here's a practical example. Go to New in the chart of accounts, select the account type, give it a clear name, and if it falls under a broader category, assign it as a sub-account. When naming accounts, use consistent terms and avoid abbreviations that might confuse you or your accountant later. For instance, always write telephone instead of sometimes phone or tel. Consistency is key, but don't go overboard. There's a sweet spot for how many accounts you should have. Chose too few and your reports are vague. Too many and you waste time managing accounts instead of running your business. Aim for between 50 and 150 accounts, depending on your complexity. If you need to segment by location or department, consider using QuickBooks classes or locations features instead of creating dozens of sub-accounts. This keeps your chart clean and your reports flexible. Also, align your chart of accounts with your tax return categories. For example, match expense accounts to IRS Schedule C or your corporation's expense categories. This alignment simplifies tax preparation and reduces your CPA's workload, which can save you money every year. Now, let's talk about common mistakes I see business owners make. First, they never revisit their chart of accounts after the initial setup. Your business evolves, and so should your accounts. Schedule quarterly reviews to prune, rename, or add accounts as needed. Second, they confuse sub-accounts with classes or locations, using one when the other is better suited. Remember, sub-accounts track financial categories, classes, and locations track operational segments. Mixing these up leads to messy reports that don't give you actionable insights. Third, they use vague account names like miscellaneous or other expenses. This is a black hole for your data. Avoid it at all costs. Today's action item is simple but powerful. Open your QuickBooks chart of accounts right now. Identify one account you never use or that no longer fits your business. Delete it. Then add one new account that reflects a key revenue or expense stream unique to your business. If you're unsure, pick a sub-account under an existing category to keep things tidy. Once you've cleaned that up, you'll be ready to move on to setting up classes and locations for even better tracking. That's where your financial data starts to become a strategic asset instead of just numbers on a page. Keep building on this foundation and you'll cut your bookkeeping headaches in half, if not more. Your business deserves that kind of clarity.